Can I ask a dumb one? Okay, everybody's getting really good at making nice, succinct statements every week. So this one comes from Ben. Ben asks, not sure if you have read Bill Perkins' Die with Zero or not, but my wife and I were inspired to plan to give the majority of our inheritance to our children, now 1 and 3 years old, when they are around 30 years old, as it will be most useful to them at this point in their lives. What type of account or giving method would be most tax efficient for giving them a large sum of money all at once? Jeremy?
Love this question. Have read Die with Zero. Also love that book. The basic premise of that book is, in addition to this amazing mathematical power of compound growth that gets better with time, a human's life and their health kind of decays with time. And so don't forget to balance those things. While it's good to save and compound for decades, don't wait till you're 80 to have some fun, because you might not want to go skydiving when you're 80, but you might when you're 40 or whatever it is. And he also translates that to inheritances. Most inheritances kind of bounce from like people in their 80s to people in their 60s. And so you die in your 80s and you get it when you're 60s. And then so it bounces through the generations. And, people in their 60s kind of aren't starting families and buying their first home and, trying to take a family vacation with their young kids and these like really important, meaningful moves in their life. And so Ben very astutely says, hey, I've taken that lesson to heart. I'm not going to wait till I die. I'm going to give it away when my kids are 30, when they are in that like very formative young adult family growth, home purchase period of their life, which I love. Love it, Ben. So you're crushing. Okay, so I have good news and bad news, Ben. The good news is what a lot of people worry about with this question is the gift tax. Oh, if I give a bunch of money to my kids, I'm going to get hit with the gift tax. And I asked you this before, Jen. I'm going to see if you know the answer, because it's the second time on this podcast I'm asking this. I think you got it right last time, though.
Halloween episode, spooky.
There is, I know, spooky. I'm like going to ask you again. There's a certain amount of money under which you can gift and pay zero tax on that amount of money. And it's a lifetime exemption, so it's cumulative over the portion of your life. And so whether you gift it while you're alive or it transfers as part of your estate after you die, how much money can you give to your kids or your beneficiaries and pay $0 in tax on it?
And this is different from the 13 million that we talked about?
No, it is the 13 million.
It is, so I nailed it.
Yeah, you nailed it. It's 13.99 million, so you're only off by $990,000. But what's $1 million between friends? But the point is, it's about $14 million this year in 2025. Next year and beyond, it goes to $15 million. And so by the time you're listening to this, it might be 2026. And as for one person, if you're a married couple, you can double it. So it's actually $30 million. And so basically, to Ben, you can give your kids literally, because it'll be beyond 2026. We can't count on that because we don't know what the future is going to hold, but if that's going to change. But as of 2026 tax law, you can give your kids $30 million in cash. Like if you have $30 million in cash in your checking account, you can transfer it to their checking account with a one-wire transfer, file a form with the government that says, I just gift my kids $30 million and say, good for you, $0 in tax owed.
Wow.
If you're above that, you're not listening to the wrong podcast. You should be donating to this podcast and be a benefactor, not a question asker. Okay, so that's the good news, is that you very likely don't have to worry about the gift tax because it's a large amount of money. But what you might be asking is, okay, I'm going to use the amazing power of compound growth and investing from the time my kids are 1 and 3 years old until the time they're 30, about 30 years for the sake of round numbers. What about taxing that? And so just to give you an example, if you invest $500 a month, put it into a regular old brokerage account for your kids, and you get a 10% rate of return, in 30 years, that $500 a month will grow to about $1.13 million, which is the amazing part of investing. You've turned your $500 a month into $1 million. Of that 1.13 million, $180,000 are contributions. That's your $500 times 12 months in the year times 30 years. That adds up to $180,000. That isn't taxed. That's already been taxed as income. You paid income tax and you earned that $500. You can take that $180,000, give it right to your kids, no tax. But that represents growth too. There's growth in that, which is $950,000. So most of that 1.13 million is the growth, $950,000.
Right.
And on that, like let's say the day they turn 30, you sell it all, you click sell on fidelity.com and you realize the gain of all $950,000, you would pay capital gains tax on that, somewhere between 0, 10, 15, or 20% federally, and maybe for your state too, depending. And so like let's say you pay 20% tax on that, that's $190,000 owed in tax. That means this $1.13 million that's grown is actually going to shrink to $940,000 after you pay the tax. It hurts a little bit because we went over the gap of the 7 to 6 figures, but
Right.
1.1 million and 0.94 million are both about $1 million. And so it's not crippling. Your kids are still going to get a lot of money. And so if you're asking, how do I avoid that? There's only one really good way. And unfortunately for you, the good way to avoid that is to die. If you, I know, spooky, Halloween.
Very Halloween-y.
If you die, your kids enjoy a step-up basis, which means instead of their basis being that $180,000 that you contributed, their basis becomes the 1.13. That means the day you die and the estate transfers, they can click sell on Fidelity and get 1.13 million and owe $0 in tax. The problem is if you want to do what you're saying and give it to them while they're alive, you're going to pay that capital gains, or they are. You can gift them, you can transfer the stock or the index fund directly to them, but then when they sell, they're going to pay the capital gains. And so my general answer, and a lot of times people ask these questions, they're saying, hey, I'm a new doctor, I make $500,000 a year. What do I do to pay no income tax? And the answer is you're going to pay income tax.
Yeah.
Like that's, the government's going to make their money. There's things you can, there's little things like you can contribute to a 401k to limit it, but that's a different question. But in this case, the answer is you're probably going to pay capital gains tax because you can't just magically get all this money. There are a few things you can do. You could put money into a 529, pay for their college, and that's essentially works like a Roth where it's tax-free. You could potentially experiment with an UGMA or an UTMA, which is a custodial brokerage account where you're basically putting all the money into your kid's name now. And then you're the custodian of it, which basically can take advantage of a slightly lower tax bracket because they're kids and don't have any income. But there's some nuances there too, where they would get the money not at 30, but they get the money at 18 or 21, depending on the state you're in, and they would still owe the capital gains tax on that as well too. So basically, my answer to you is good news. Don't worry about the gift tax. It probably won't impact you. If it does, please send donations this way. And two. You're probably going to be on the hook for some capital gains if you have a ton of growth over these years.
Yeah, if your kids turn 30 and 33, if that 1-year-old and a 3-year-old, so the 1-year-old's a doctor, the 3-year-old's a lawyer, you can be like, yeah, maybe I'll wait a little bit longer. They're fine for now. They don't need this money at 30. You know what I mean? Depending on your kid's situation.
And, in that moment, you said, I want to give them a big lump sum at 30. You can maybe decide, you're like, I can maybe stretch this out and wait till a low tax year, yada, yada, yada. So there's some games you can play in that moment. But, the question to you, the way you formed it is if you're going to sell everything and give them write them a big check on that day, you're going to pay some capital gains tax.
Okay. Thank you, Ben, for your question. Hope that answered it. And we'll move on to our next segment.